we are dealing with mutual funds. And in our last session, we had an introduction to mutual funds. And after telling you what mutual funds are, I also started a pretty long session on what to watch out for mutual funds. It's very important. There are many financial products, just like there are other industrial products, which convey certain value, but there are no perfect products. So when there are no perfect products, we have to know what are the pitfalls, what are the disadvantages of a particular investment strategy, what are the disadvantages of a service provider. And only when we have a good understanding of these disadvantages will we be able to come to a conclusion of how to use them, how much to use them, in what context to use them. Probably something I pointed out to you in the last session was how mutual funds tend to advertise their hot funds or their best performing funds of a certain period. And very often the best performing funds of one period turn out to be the worst performing funds of another period. It's essentially a game of musical chairs. So I just pointed that out to you. And it's very important that we have a basic understanding of mutual funds, both their advantages and disadvantages, simply because for a normal person, especially for a young person in India today, if you want to be an effective, serious saver and investor, at some point of time, you will have to make use of certain mutual fund plans. So today let us start by looking at one more aspect of mutual funds, which is very, very important, and that is costs. Costs are important in any investment avenue. Costs are important, period. They are important. The point at which I would like to start on costs is, if we think that we can do any activity today without a cost, we are sadly mistaken. You buy insurance, there is a cost. You invest, nobody is going to do it free. The people who facilitate the investment also have to make money. For anything to live your life, you have what we call normal living expenses. That's a cost. It's a cost of living. So there is no way we can avoid costs, but we should understand the importance of costs. We should understand how to look for lower cost options or lower cost products. That is very important. And in the context of investment, especially investment in mutual funds, John Bogle says it beautifully. The surest route to top quartile returns is bottom quartile expenses. Worldwide, mutual funds are very fond of showing their performance in this kind, something like this, where they divide a simple bar or a bar diagram into 4 parts. So each of these is equal, so it's 25%. And these quarters, or as they call them, quartiles. Is my fund in the top 25% in performance? Is it here? Is it there? What happens is, well, sometimes the fund lands here, 1 year later it may be here, another year later it may be somewhere here, it may come back to number 1 again. What they try to look at when they divide into these top quartiles is a fund consistently in 1 or 2, then it's a good fund. Once in a way, it may, over a 10-year period or 15-year period, it may even drop into number 3 for a year or 2. But is it most of the time somewhere here? If this is the average line, if most of the time the fund is somewhere here, it means that its performance is above average. Now in that context, John Bogle is telling us that the surest route to top quartile returns, if a fund is to be consistently found somewhere here, what should be its characteristic? He says where its expenses are concerned, where the costs that it charges the investor are concerned, those costs should be here. Why? Because the costs are not borne by the mutual fund. The costs are borne by investors. It is out of your money that certain costs are taken. You buy stocks, brokerage is charged. You sell stocks, brokerage is deducted. Who pays? The person buying or selling the stocks pays. And who is that person? Investor. Similarly, when certain amounts are charged to you by insurance companies, by wealth managers, portfolio managers, by mutual funds, by anyone, those costs come out of your pocket, the investor's pocket. And John Bogle says, the lesser costs are, the lesser the costs, the better the performance. So the one really sure way of landing here is to keep your costs low, keep your costs very low. Now, I'm not going into all this in detail. These next few slides are actually prepared for another class of mine where I go into teaching this in detail. But I'll just skim these things. Formerly, something like 6% was allowed when a fund launched for the first time, what they call a new fund offer, the equivalent of a rough equivalent of a equity IPO. 6% was allowed. That means out of every 100 rupees the investor is investing, only 94 rupees goes into investment. 6 rupees are gone at expense. You start being a loser. You start itself as a loser. Fortunately, SEBI has done away with all that. But the one thing that an investor must be aware of and must focus on is something called annual recurring expenses. These are charged to the assets managed by the mutual fund on an annual basis, because the asset management company also has a number of expenses. You can see the expenses there. They maintain offices, they have staff, they depend on certain service providers like registrars and transfer agents, custodians, bankers. There are costs involved. Even sending of statements many times. Not everybody is internet savvy. So with all these things, advertising and publicity, sales promotion, so all these costs are charged by the mutual funds. Of course, the costs are regulated. They can't charge what they want. We will see a little bit of what those costs are. Then mutual funds also purchase and sell various securities. If it is a debt mutual fund, there may be corporate securities and government securities to be bought and sold. If it's an equity fund, from time to time, certain stocks have to be bought and sold. Now, the stocks can be bought or sold, or the securities can be bought or sold for various reasons. One reason is to manage inflows and outflows. Every day there are people investing, every day there are people taking out. On certain days, the inflows may be more than the outflows. On other days, it may be in the reverse order. All those have to be managed. Second, if it's an equity fund, the fund manager may have bought certain stocks. The stocks might have appreciated. The fund manager now says, I want to book some profits here. So they sell the stocks. There may be other cases where I thought the share will go up, it never went up, I don't want to hang on to it now, I want to sell. A new stock may be identified by his research people as promising. They will buy. All these things happen. Even in an index fund, which is very passive, at least to manage the inflows and the outflows, or to manage rarely one or two changes in the index, a little bit of churning is required there also. So churning as well as administrative expenses are part of the costs. There is one more very bad and very dangerous thing called loads. Formerly, for the privilege of investing in a mutual fund, in addition to the annual recurring expenses, you were charged something like a brokerage. Let's assume that it was a 2% entry load. So when you invest, straight away 2% used to be cut. And mainly that 2% was used to pay commission to mutual fund distributors and to promote sales. Now fortunately for us, SEBI has done away with all entry loads in India. Today when you invest, 100% of your investment goes into the investment. The annual recurring expenses are different. But at the very source, like you have tax deduction at source, at the very source, there is no load charged to you. Debt mutual funds generally have either no loads or lower loads than equity mutual funds. Now, SEBI has only done away with entry loads. Please note that there are exit loads, especially in equity funds and some debt funds. The period for exit loads in debt funds is generally lower. Period for equity funds may be between 1 year and 3 years. If you withdraw before 1 year, most of them are if you withdraw before 1 year, you can lose up to 1% to 3%. There's a penalty. There is a penalty. Now, I have no quarrel with exit loads, simply because when you get into an investment, you should be clear about what your objective is. If I'm going to get into an equity fund and get out after 6 months, when the minimum holding period for equity investments is 5 years, I deserve to pay some penalty. I have no quarrel with this at all. The good thing about loads is, if you have your objectives clear, if you are going to be in equity funds for the long term, you don't have to worry. No loads will be charged to you. And generally, no mutual fund charges both entry as well as exit. In any case, in India, we have done away. Luckily, SEBI did a very good thing there. Did totally away with the entry loads. Only exit loads are there. And this is the important part, the last point. If you are an investor in the stock market in India today, equity fund, balanced fund, asset allocation fund, anything that has got a touch of equity, and you respect the equity time of 5 years, then you simply do not have to worry about the impact of exit loads. Long before that, there will be no exit loads. So when you redeem, you will get the net asset value without a load. Now, what remains and what is dangerous from the point of view of an investor is this. So, I'll spend just a few minutes on this before we pass on to the investment part. The annual recurring expenses. For managing your money, certain expenses are charged. They are allowed to be charged. There is a certain percentage. The percentage is based on or related to the amount of assets that the mutual fund is managing. And the implication is, if I am allowed an asset management fee of 2.5% on an equity fund, let's say, I have 100 crores under management, my expenses for that year cannot be more than 2.5 crores. Of course, I'm making it very simple. The actual calculation is on a weekly basis, but we will keep that aside. Which means that if my expenses are 3 crores, only 2.5 crores can be charged to the assets of the investors. The half crore has to be borne by the asset management company. That's the implication. Now, here is how they are. This is just for general knowledge, how they are capped. For the first 100 crores of net assets, they are allowed to charge up to 2.5%. And then as the fund size grows, you can see that the expenses come down. You have heard of the term economies of scale. Something like this. Debt funds have it less by 0.25%. Whatever the figures you see here, deduct 0.25% for them. Now, this is what is actually being charged by the mutual funds. One or two points that I have to make here. This is a maximum. Mutual funds do not have to charge this. This is the maximum that they have to charge. They can charge less if they want. In fact, there are some good funds, old established funds, which have got huge assets under management. They themselves, after a point of time, reduce the total expenses that they can charge. There are other funds, whether they are long established or not, they try to squeeze every penny from the investor, so they'll always be at the maximum caps. Now, unfortunately in India, the mutual fund industry is hardly 20 years old. In 96, 97, after the SEBI regulations that brought a regulatory framework up to international standards, only from that time onwards can we say that we have got some standard mutual funds in India. Private sector mutual funds came about. Some of the public sector mutual funds also had tie-ups with certain foreign entities, and the whole thing developed. Having said that, it's been a reasonably impressive journey in the last 2 decades. But we are absolute pygmies when compared to the mutual funds of the developed countries. Therefore, the real economies of scale are not seen in the Indian mutual funds market so far. Also, index funds, which are much less expensive, have not really taken off in India. No mutual fund really markets them. No mutual fund distributors, very few mutual fund distributors would market index funds, although index funds are the thing of the future. Just for your information, you have seen all these figures, 2.5% down. Index funds in India have expense ratios of 1% on the average. Some of them have a little less, some of them may have a little more, but on the average they are 1%. So when we hear of that 1%, we should understand it in the context that is correct. Take a simple index fund in India, there are plenty of them, which invests in the NSE 50 index. You have heard of the Nifty index, NSE 50 index. It's good to do a simple awareness exercise, either on your internet computer or you take your newspaper. Take the Nifty, the stock market page. You'll find the Nifty stock market quotations. Forget the quotations. Just read the names of the companies from A to Z. Read the names of the companies. Probably it will not take you more than 2 minutes or 3 minutes. If you just read those 50 names, you will come to the conclusion that while every good company in India is not there, this is a basket, a well-diversified basket of some of India's best companies, which means it passes muster, it is sufficient for a reasonably well-diversified portfolio. If you want to stretch your imagination a little bit, on the website, they will also give you the shares in the NSE or BSE 100 index. Worth reading that also sometimes, just as an awareness exercise. So, unfortunately, there are no mutual funds that track the 100 index, only the Nifty and the Sensex, of course. Now, if you look at that, you will find that, okay, this is a well-diversified portfolio. Now, you compare this portfolio with the portfolio of an actively managed mutual fund. Those portfolios also are available on the websites and they are fact sheets. You will find that good deal of the Nifty companies will also be there in any large cap fund. So you say, these people are charging, let's say, 2.5. Index fund is 1%. Let me go to the index fund. You have made a journey to lower costs. And compared to 2.5, a 1% charge by an index fund may appear to be much less. However, if you view things in the global context, in the United States, the expense ratios of index funds have dropped to 0.1% or even less than this. And our index funds are 1%. So, when we talk about costs, in the United States, over a 10-year period, 80% of the actively managed large cap funds underperform the S&P 500 index, which means in the United States, if I am a regular long-term investor and I am choosing actively managed funds over index funds, I am a fool. I am absolutely illiterate where investment is concerned. You have these quartiles. Index funds will be consistently found here. They will be consistently found here. And the higher the cost of the actively managed people, the lower will their funds drop there. But we are talking about such small expense ratios, 0.07%, 0.08%, 0.1%. And in India, we are talking about 1% for indexing. And we are talking about 2.5% for actively managed funds. So costs are high. Costs are high. There are reasons for it. In India, the expenses are also high. There are a lot of market inefficiencies. Our stock markets do not have the depth. Mutual funds, you may read in the papers, they have crossed 19 lakh crore, 20 lakh crore total. Compare it to bank deposit figures, other figures, pathetic. Only now, slowly people are getting attracted to mutual funds, and at least I'm happy to see that people are into that SIP culture. But you still need to see how investors will behave when the next crash happens. Will they continue their investment programs which are important? Will they panic and run away? So all these things have to be seen. It's very easy to say, we are going to 18 lakhs, 19 lakh crores, 20 lakh crores as the markets are rising. Just because those 18, 19, 20 nice figures keep flashing on your screens or in your newspaper pages does not mean that the mutual fund industry itself is growing. It means that the values of the assets that they are holding are going up. Therefore, you have those things. It also means to a certain extent that more people are coming in than going out, because you'll also find other numbers in the statistics, like the number of mutual fund folios, the number of investors who are there, the total investors, the total number of systematic investment plans. All these look promising because we have a large and pretty vibrant middle class. And mutual funds is a mechanism fantastically well suited for the middle class. If you read a book called The Millionaire Next Door by Thomas Stanley and William Danko, that book is about not people who were born millionaires, not people who won lotteries, not people who inherited money. It is about normal people who started life as either middle class or lower middle class. But 40 years later, that's at the rough time of their retirement, they were millionaires. So people who did not have these large strokes of good fortune, inheritance, lotteries, how they built wealth across 3-4 decades. That's that beautiful book called The Millionaire Next Door. It's a very good book for anybody who wants to start to read about investment. That's a beautiful book to start to read. Unfortunately, they didn't update it. It's a 1995 book, but reprints are available. So we are talking about these kind of people, middle class or lower middle class. Now, what magic did they do to end up as millionaires? They didn't do any magic. The magic was perseverance, regularity, keeping on investing. Rules, their life rules were very simple. We will work hard, we will earn. We will ensure that our expenditure is less than our income. Then after you pay your taxes or whatever it is, there will be some surplus. That surplus will be regularly and in a disciplined manner invested. And invested for the very long term. And invested using mainly vehicles like mutual funds. So, mutual funds are an asset class that beautifully fits into the middle class strata of society. It's not that the wealthy cannot use them, but the wealthy may not need them as much as the middle class does. And India has a large, thriving, vibrant middle class. In fact, more people are slowly being shifted from the lower sections or lower middle class or the poor, slowly coming up because everybody has aspirations. Everybody is trying to better their lot. And the kind of market-oriented economic systems we have are creating more opportunities, not just in employment but also in entrepreneurship. And therefore, as people move up in the economic scheme of things, we will find that more people will be coming into mutual funds. Now, the mutual funds also must recognize this and reciprocate. How can mutual funds reciprocate? They can reciprocate by coming out with simple products. We have needlessly made things complex. If you ever read that mutual funds are consolidating schemes, trying to reduce the schemes, it's not because they wanted to do it. When they were allowed a free rein, they came out with needlessly with extra and extra and extra schemes for various reasons. It is SEBI has cracked the whip. SEBI has asked for a consolidation of mutual funds, for reduction of the number, for making things simple. Therefore, we have some good products, but I'm not still satisfied with that the products are optimum. But when you don't have anything better, it's somewhere here you have to start. So the first thing that I wanted to tell you was the one thing that's going to be charged to you on an annual basis. In fact, when you talk about load versus annual recurring expense, a load by itself may not be that dangerous. Because to give you an example, we say that the mutual equity fund time horizon is 5 years. Supposing there were an entry load in India and reasonably high entry load of 2%. So when you make your investment, you pay 2%. Now you are going to hold on to the investment for 1, 2, 3, 4, 5 years. Once this 2% is charged to you as a load versus annual recurring. Okay, I'll use the Indian term for it. We call it the total expense ratio. This is for the annual recurring expense. And we'll assume that that is 2.5%. The load is charged to you of 2%, and then it is nothing. Nothing is charged on the load front. But the annual recurring expenses are, as the term tells you, annual and recurring. So when you do your maths after 5 years, what is this? 12.5? This continues to be 2. I'm not saying that this should be reintroduced, please. This is a good thing that they have got away with it or done away with it. I'm saying that this should be reduced. Nobody is asking the mutual funds to work free. I don't work free. Nobody is asking the mutual funds to work free. But what SEBI should do is, they should balance as they see the number of investors coming in, the assets, investors' money coming into the mutual fund industry. As they study the balance sheets of your asset management companies, I think there should be some control here. Of course, SEBI is concerned with this, but sometimes they think that competition will slowly get it down. It's not been happening. Even abroad, it's not happened. It did not happen because there was competition between actively managed funds. There was a tacit understanding. You scratch my back, I scratch yours. I will not reduce, you don't reduce, we'll both make money. That's the kind of attitude. What got down this thing in the United States was the entry of index funds. After John Bogle in 1976, I think, was successful in packaging the first index fund to investors. No magic happened for 10 to 15 years. In fact, he was in big trouble, always under losses. Vanguard was not a profitable company. But he had that very, very strong belief that what I'm doing is right, what I'm doing is just, what I'm doing is in the interest of the investor. So that slowly, as the academicians then started having a 10-year, 20-year track record of what was happening in investing. As we came to the turn of the century, maybe 24, 25 years after John Bogle's first Vanguard S&P 500 index fund, and the Vanguard S&P 500 index fund did not start with an expense ratio of 0.07 or 0.08. It started with an expense ratio that might have been 0.5% or so, but much, much lower, maybe 1/3, 1/4 of what the active management was. But the greatness of John Bogle was as money slowly started to come into the index funds, he on his own kept on reducing the expense ratio. On his own, nobody had to tell him to do it. That was his, till it came down all the way. Then more and more people realized that the lower the expenses, the higher our returns, and that it is possible to have a passive, simple product that will invest in the stock market, that will capture the returns of the stock market, and that will not fleece us. I asked you to do a simple study of reading the names of companies. You can't have anything simpler than that. A to Z of the Nifty. Now, there is a Nifty index fund. All the leading mutual funds have their own index fund, so it doesn't matter whose it is. So let's say of a particular mutual fund, you start a simple SIP of 1,000 rupees per month, a systematic investment plan of 1,000 rupees per month. Many of us just take this for granted. I started an SIP into XYZ Nifty index fund. Do you know the power that there is between that simple action of yours? The mutual fund has given you, or the mutual fund industry has given you, the facility of taking an ownership stake in 50 leading companies in India. Yes, to a very small extent, but ownership stake in 50 leading companies in India just by investing a paltry 1,000 rupees per month. And if it's an SIP, when the same date rolls around the next month, you're repeating the exercise again. Now, there is one mutual fund in India that has a fund called the Next 50. So, the Nifty is the first 50. Now, we have the Next 50, which means between the two, you have 100 companies. Supposing you put, you start an SIP of 1,000 rupees in the first 50 and 1,000 rupees in the next 50. I think you may be even able to do 500, 500. It all depends on the fund. But whatever it is, let's take 1,000, because even 2,000 a month is something that even lower middle class families in India can, where there are two working members, can afford today for savings. They are actually saving more than that, let me tell you, because my office also has half a dozen or more rickshaw drivers who are in SIPs. So 2,000 is not a big deal to save. With 2,000 rupees a month, you are taking a stake and you are repeating that commitment to that stake every month in India's top 100 companies. Now for that, you are being charged, yes. So if you go to the Vanguard S&P 500 index fund, you look at the power of the investors there. For $100 maybe per month, $100 per month, which is not a very big deal in the United States, I'm able to take a stake in the top 500 companies in the United States. And the United States have also schemes that have what are called total stock market index funds. So if there are 4,000 companies, today there are about roughly 4,000 companies in the United States. You'll be surprised to know that 20, 25, 30 years back, there were 8,000 publicly listed companies. The number of companies in the United States have virtually halved from 8,000 to 4,000. Not because they are closing companies. A lot of them have gone private once again. There have been mergers, amalgamations, takeovers. Not every enterprise will want to list on the stock exchanges. But there are index funds where with your $100, you can take a stake in the entire United States market, the whole stock market, the whole 4,000 companies. Now, this is the kind of force multiplying effect that a mutual fund has. And that is why I said, for any normal young person today who is going to invest for the long term, if you do not use mutual funds, you're making a mistake. You have to only know what to use, how to use, and to what extent to use. So, because of these kind of things, in India, coming back to India, I told you 1,000 rupees SIP into Nifty, 2,000 rupees, 1,000 Nifty, 1,000 Next 50. For an expense ratio of 1%, which is about 40% cheaper than the average actively managed fund. you are repeatedly taking a stake in India's top 100 companies. So this is the kind of power that investors today have, which was not there even in 1985 when I started my career in financial services. You are the stock market. The only mutual fund was, I hesitate to call it a mutual fund, Unit Trust of India, which then collapsed under its own weight. Whatever NAV they had was a work of fiction. I think when they finally did the maths, if my memory serves me right, the actual NAV was 50% lesser than what they were busy publishing. Today things are different. Today things are totally different. Very well regulated, etc. But whatever it is, you have understood the importance of looking at costs and giving costs a very, very good. Unfortunately, SEBI has done one or two things which have actually increased costs. I'm not going deep into this, just to tell you a little bit of it. To spread the equity cult or the mutual fund investing cult beyond the top 15 cities, because most of the money comes from the top 15 cities. To do that, the distributors like us, people from Mangalore, they decided to pay an extra brokerage of something like 0.3%. Unfortunately, that has pushed up costs. I hope at some point of time they do away with it. Yes, there is one very important thing that investors must be aware of. And in my opinion, what SEBI has done is good. Today, there is something called a direct option. You can directly go to the mutual fund and make your investment. Now, if you do this, all these commissions and sales expenses that they pay to the distributors, the mutual fund cannot charge this to the investor under the direct option. You are not going through a mutual fund agent or a distributor. So you can go and you could end up saving something like between 0.5% and 0.75%. This is what you will end up saving if you bypass a distributor. Now, if you choose this, of course, no distributor will service you. But given the levels of both service as well as investment advising quality of most distributors, I don't know whether that's a big loss, especially if it is an intelligent and educated investor. And the quality distributors, people like Simplus, they will continue to get the business, whether there are direct options or any kind of thing. People will still come to them without any problem, because there is a role for a distributor. A lot of these things are seen as threats. Oh, they are coming out of the direct option, we are threatened. Who feels threatened? If a distributor is feeling threatened, there is something wrong with the distributor. I can agree if SEBI says no more commissions in India, totally, all commissions are gone. It is a threat. Even then you have to then shift to some other system. But if you want to continue. But if you're only giving an option to the investor, that you have a option to go to a direct plan where the expense ratio is less, you can reduce your cost. Of course, you will not be going through a distributor. You will not be getting any service from a distributor. If you think that the value of service that I'm getting from the distributor is not even up to this mark, it is a good idea to go direct. But distributors, the quality distributors, will continue to get business because quality distributors give a number of services to their clients. Not only do they pick some good funds for them, when I say good, it does not mean better performing. At least, have they been around for some time? Are the expense ratios a little reasonable there? Secondly, is that particular fund that I'm picking suited to this particular client from my knowledge, my experience, and the client's own capacity to take risk, or the client's need? Forget the risk capacity, the client's need. That kind of judgment cannot be valued in terms of money. And that's not the only service that a distributor gives. That's only the starting point. Every other transaction, You want some changes. It can be simple things like I'm a resident, then I become a non-resident, then I become a resident again. KYC formalities, change of KYC formalities. I want my email changed. I want my telephone number changed. I want my bank account changed. I want my address changed. Somebody dies, the transmission of their units to the nominee, to the joint holder. These are processes. There's an even more important role that a quality distributor plays. Very few people appreciate this. What is that role? What happens in the bad times? Today, markets are going up every day. Nobody's bothered. The party is going on. But as in all halls and hotels and others, at some point of time, a bell will ring and they'll say, party is over. Then the hangover. Now, during the hangover, you need somebody to hold your hand. When the markets are down, when everybody is saying things are bleak, nothing's going to happen. Actually, that's a good time to invest. But people are saying, no, my mutual fund investments, every time I get my monthly statement, I can only see every month it's going down by X amount. So I want to sell, I want to get out. During that time, I want to stop my SIP. I want to shift everything to debt. That is the time when the true value of a distributor, a good advisor, is seen. Because they will explain to the client that ups and downs in the market are nothing but normal economic cycles. This is normal behavior. You look at a person who's sleeping. What's the difference between sleep and death? The absence of life. You see the chest moving up and down. There's breath. There's the activity of breathing. If there is no such activity, the person is no more. Economic cycles are the breath of the markets. It is showing you that the markets are breathing, the markets are working. If there are no ups and downs, booms and recessions, whether economic or market oriented, sometimes bubbles. Just like a person can get very excited by something in real life, and the heart rate can go up. The breaths can be much more frequent. Or somebody can be really tired. I'm totally going to now have a long sound sleep where the whole level of activity reduces. Exactly the same thing in the markets. So recessions, ups and downs are part of the market. And it is the duty of the advisor, especially the good advisor, to convey this to the client. You have your investing program. It is the business of the market to fluctuate. It is the business of the market to undergo boom and recession cycles. It is your business to continue your investing program. I've seen a number of good distributors because of whom people continued investing. I still remember a client who had come to me some years back. I want to become a client of your firm. When going through the papers, you're a client of this firm. I said, yes. I said, I know this firm and I know that they are good people. Why do you want to change? No, there was this global financial crisis. I wanted to stop my SIPs. I wanted to actually cash out some equity fund. That person virtually forced me not just to cash out but to continue investing. I said, okay. So what happened finally? I continued investing right as the markets fell 50%. So I said, so does that make him a bad distributor? He said, yeah, there were so many losses. I said, okay, but the markets have recovered. Yes, but if I had wanted to sell at that time, I said, no, from what I see here, if you had wanted money, the person had set up a separate emergency fund for you. This was the fund to be taken. Then I said, you please go, I'm not taking you as a client, you please go and get from that other distributor a report of all your SIP transactions. What you have brought me is only a summary. Take one mutual fund. That was an equity fund, a diversified equity fund, and take the summary of your transactions from day one. from day one of your SIP, which started little before the global financial crisis, about 6 months or 8 months when the markets were going up. And I want you to give it to me with the returns worked out, the compounded annualized returns worked out. There's a software that will do it. So he said, okay. And he came to me. About 7-8 years of SIP, I think it was between 2007 and 2014. This might have happened in 2014. I told him, now please read line by line your investment that has gone into this equity fund. At the end, there is one column that gives you for each installment, it gives you the return. Because an SIP is nothing but many investments. Each one is a different investment. So he started reading. In 2007, what investments had taken place? Some 8%, 9%. Then we come to 2008 at the peak. That was showing something like 6%, even after several years. Then he starts reading and his eyes start popping out. I don't have to tell him anything. Because as the markets are falling in 2008, right till 2009, for that 14-month period, 14 installments have gone in. Each investment is showing a higher return. Why? We are looking at the return in 2014 of investments done in 2008, 2009. As the markets went down, as the NAVs went down, he was purchasing things lower. The lower he purchased, the better the return was when the markets were high. Some of those figures were 18%, 21%, 20%. And he's saying, you want to change your distributor. But this is what your distributor gave you by persuading you to remain in the market. Then he shook his head and he left the office. And I also was convinced that he'll remain with that distributor for the rest of his life. Okay, because sometimes this is what happens. Even a good work done is not appreciated unless somebody points out or is able to present the data in a particular way. This is what has happened. Is such a distributor you should be with, you should not leave. So, distributors have a role to play. Good financial advisors, especially people who place a little value on ethics, they have a role to play. Investors will flock to them. Investors will not leave them. They do have nothing to worry. So, you have this thing of quality distributors who don't have to worry about things like the direct options. You have also quality investors. If you are a quality investor, you are very tech savvy, you are net savvy, you can sit in the comfort of your home and do whatever transactions for mutual funds you want. You don't have to depend upon a distributor either for advice or for operations or for hand holding. Fine, choose the direct option, no problem. No problem, there is room for everyone, there is space for everyone. So, this is another thing, the direct option is also something to know.